Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, our guest is Denis Shapiro. Denis began investing in real estate in 2012. He's progressed into active and passive deals across various asset classes and types. He co-founded an investment club for accredited investors in 2021, and he also wrote Alternative Investment Almanac, expert insights on building personal wealth in non-traditional ways, where he interviewed some of the best alternative investors in their respective industries. So he compiled details on different types of investing, different asset classes with different experts, put it in a book for passive investors so you can understand how to be better diversified. We discuss operating a fund, specifically an income fund that he has created, and why he likes that model, how he's better diversified. We go into detail about those dynamics that maybe you should think about, mortgage notes, ATMs, including that in a fund that also has multifamily and maybe self-storage and different things. So I hope you enjoy the show. Denis, welcome to the show. I know you are operating a fund, and the fund model has received a lot of interest lately in our industry, no doubt about it. So I'm looking forward to the conversation because I think you do some specific things about the structure of this fund that's probably beneficial for many of us to know about, whether you're passive or active. That's going to be helpful. But give us a little more about your background, how you got to this point in your real estate business.
Whitney, thank you so much for having me. It's a pleasure to be here. A big fan of the show. So I started investing in traditional assets about 20 years ago when my brother gave me a copy of Rich Dad Poor Dad. I was in high school at the time. Absolutely hated the book at the time because I was 14. What did I know? But a little bit after that, I purchased my first mutual fund at the time, and I waited a year. And of course, I didn't really get rich. I think it went up by like $7. I started looking at different options in the traditional world. Then I got my first full-time job. I actually got a job from the government. And I realized really quickly from my first paycheck that the government was not only my employer, they were my partner with the amount of taxes they were taking. And that kind of got me into the rabbit hole of investing in alternative assets. So I've been investing in traditional assets for 20 years. I've been investing in alternative assets for the last 9 years or so. And what I've really noticed, and the big reason for my fund, is that traditional assets are kind of great where you could kind of set it, forget it. Let's say you put it in the index fund, long-term appreciation, it can do fairly well with minimal brain power. Now, what I found really difficult to get out of my traditional assets was income. I literally tried every strategy known to the stock world, high utilities and high yield bonds and REITs and MLPs, and every single strategy failed because the volatility of the stock market destroys the yield. It took me years to realize that. And while I was looking at was while I was ramping up my alternative investments, I was like, wow, the alternative assets, there's almost little to no volatility here, and they provide great income, but they require what I like to say, being actively passive, where you have to kind of learn the basics. You have to learn the language of real estate. You have to learn how to underwrite, the basics, at least how to underwrite. You have to meet with people that you trust. You need to network, and that takes time. So what I realized is if I could put my traditional portfolio on standby, not on standby, but on autopilot, I could really focus my attention on the alternative assets and really hone in on what each asset class is actually really good at versus saying one is better than the other.
No, that's awesome. Sounds like just a track record of diving into different types of investments. You've learned a lot, and it's helped you to get to where you're at now. So you have a better understanding, can help lots of other people build that wealth and build the income they're looking for. And, that doesn't always happen overnight. That's for sure, does it? Just figuring out how to do it, how we should be investing and things we should know about investing and much less actually building that income. And so, let's dive in a little bit to, you've started a fund. Why would you have a fund? What does that look like? Why is it different than other funds? And let's jump in.
Yeah, so what I wanted to do was I come from a background where I was like, if I was 10 years ago before I got into alternative space, I wanted a portfolio where it can appreciate and provide me income at the same time. Couldn't find that in the traditional world. So when I designed a fund, I was like, what would I have liked to have seen 10 years ago? What I was really looking for was a REIT that's not publicly traded, that wasn't traded on the stock market, where you could kind of sign up, know what you're kind of getting into, and hopefully constant and steady, but at the same time you're not dealing with the market fluctuations. So when I designed my fund, that was the number one thing I had in mind. I wanted to create an income fund first, and that's the big difference, because there's a lot of real estate funds out there, but their number one goal isn't always income. It's appreciation. Sometimes it has tax benefits inside. I wanted to create strictly an income fund. And in order to do that, I knew that the number one tool that I have is real estate and syndications, stuff that you do. But I also knew that I had 10 years of investing in other stuff like notes and life insurance funds and ATM funds. And what I wanted to do is I wanted to create a portfolio that actually blends a few of these assets together, which will allow my investors to actually have higher income from day one and not have to depend on the back end returns, where if the business model doesn't do very well, they might never see. Or if the market tanks, they might never see.
Okay, no, that is an interesting approach, and just need to think about, because it's often, yeah, if an operator is doing a large value add project or deep value add, like some of us talk about, where they're having to vacate half a property, or not even that sometimes. But even, just turning a lot of properties around, it's hard to have much cash flow right then. And preferred return is the first portion of any cash flow. If there's no cash flow, guess what? There's no return. Nothing's being distributed out to investors often on the first few months. But what you've done, you're pulling in other assets or other types of investments inside of your fund, so they're cash flowing quickly, right? Right off the bat. What is that? Could you kind of go through that a little bit? What are some things that you're incorporating in your fund so investors are receiving the income that they're looking for?
Sure. And you definitely made a good point with that lag. I like to call it the lag. And, a lot of syndicators will say, hey, they paid the same amount on day one. But the problem is then you have to use kind of common sense. How are they paying that from day one? Because, there's closing costs. It's expensive to buy an apartment building. So what I wanted to do is, when I structured my fund, majority of my assets are all real estate. So my bread and butter is apartment building syndications. That's kind of how I got introduced into alternative investments, and that's kind of my core focus. So what happened, what I realized is, when I was investing in apartment buildings, and I was networking with other apartment building investors, was I was starting to get introduced to other spaces where the language and everything else that you need before investing, I already kind of had, because I was doing the apartment buildings. So for example, if you know how to invest in apartment buildings, you probably can figure out how to invest in a self-storage or a mobile home park. So when I started doing a fund, I didn't want to be a jack of all trades. So even though it's a multi-asset fund where I do have apartment buildings, majority of it's still real estate. So it's apartment buildings, it's self-storage, mobile home parks. And the two different assets that I put in there to give me that higher yield from day one was going to be mortgage notes, and the other one is an ATM fund, because their business model is much more heavier cash flow. So I wanted to blend the longer term appreciation from the syndications of apartment buildings, mobile home parks, and self-storage with the instant cash flow of the ATM fund and the mortgage notes.
Interesting. So that's something we don't talk about very often on the show, is something like mortgage notes or ATMs. Could you just, what's something an investor needs to know about when somebody's saying, hey, we're investing in or bringing mortgage notes inside the fund or ATMs? Why should that be beneficial to them? And maybe some red flags even that they should be considering.
Well, it's a great that you brought that up, because I just recently published my book, The Alternative Investment Almanac, and I do talk about ATM funds, and ATM funds is like one of the top 10 SEC Ponzi scheme, watch out for, because it's such a high cash flow influx of buildings. It's such a high cash flow business that it tends to lead to, if the operator has, unscrupulous intentions, they could kind of hide it for a fairly long time. So that would definitely be a red flag. You have to, like, I go through a really intensive due diligence checklist where I kind of got the checklist from a really well-regarded ATM. Maybe underwriter, I don't know the exact term you would call him, but he's well regarded in the space because the due diligence he performs on ATM operators has been called painful by the operator that I ended up investing with. So it's that type of, you have to be really, really careful. Mortgage notes a little less so, because everything is kind of documented really well. You're going to have lawyers look over the documents. But ATM funds, you need to be a little bit more careful, really do your homework, because there are, unfortunately, unscrupulous people out there.
Yeah, no doubt about it. Whether it's multifamily or ATMs or whatever, you got to do some homework. No doubt. So you understand who this person is you're investing with, or working with someone who has done that legwork for you, one way or the other. Right, ensuring that you know who you're partnering with. I hear too many stories often where people have been burned, by not doing due diligence. But let's say, speak to the fund structure a little bit. Like, this was an income fund. You mentioned like some funds may focus on appreciation and some on taxes, or how does that change the structure as far as the type of fund that you have?
Sure. So the way that I did it is, since it's an income fund, it is only towards accredited investors. I want to make sure I put that out there. My SEC attorney would probably be very upset if I didn't. So it's only towards accredited investors. And the way that I structured is, because I seeded a lot of the fund myself initially, a lot of the investments are already cash flowing. So when my investors kind of start, when they kind of sign up into the fund, they're more or less already signing up towards investments that are already producing. And that's a big difference that you get from other funds that, if it's a blind fund or the assets haven't been identified yet, the lag is going to be a lot longer from the time that the investor actually starts seeing. Like on a few of the deals that my fund has invested in, I have to wait 6 months for the investments to actually start distributing. So a lot of times, if you invest in a fund that's structured the right way, you can kind of take advantage of that, and you can actually invest in the fund and kind of start getting distributions almost right away.
Nice. Well, it's interesting, like you can invest in a fund that's diversified, or you can invest, yourself and try to be diversified. What are some thoughts you have around, diversification? It sounds like, you've done that in this fund, but maybe you can explain that a little bit, inside the fund versus someone trying to diversify their own portfolio.
So the one thing I have to say is, at first, when I started with funds, it's more like how I also started with traditional assets. I kind of wanted to do everything myself. One thing in the alternative space you real quickly realize is that it's very capital intensive. Most of the investments in the alternative investment, especially syndication space, I would say the average is about 50,000, the minimum investment. So by being able to go into a fund, your $50,000 will go into, a group of assets. One of my funds that I invested, my fund actually invests in other funds as well, just because of that diversification play. So one of the funds that we invested in, has 40 assets already, producing. So there's huge advantage, especially when starting out. I would say it pays to look at a fund. The other thing that you kind of get is, if you get a transparent fund operator, you kind of really get a great sneak peek of what's going on. For example, the operator that I invested in mobile home parks and self-storage, I see the whole portfolio. I see the markets that are performing well. I see the track record of those deals. So I don't have to do 25 different deals to get a good sense of geographically where I should focus my own portfolio in. So when you sign up with the right fund operator that is, takes his time to educate you and really clarify how their portfolio is actually performing, then you can't really beat that if you're going to just do one deal, because then if that one deal stops performing, you don't know if it's the operator, the property manager, which you hear 9 out of 10 is the number one reason why a deal is not performing, right? So you don't know if it's the property manager, it's the location, if it's the sub-location, if it's a geographic, if it's a natural disaster. But when you invest in a whole fund, that matters less. It just you might not get that home run, but starting out, take the base hits, because that you'll go further that way.
Yeah, no, I mean, I the more I learn about funds, the more I like this, the multiple property or a strategy, right? A multiple asset strategy versus a single asset strategy. And even as a passive investor, often investors will say, well, they can't see the deals, right? They can't see, when you're doing a fund like this. But you're trusting the operator so much anyway, even on a single asset syndication. I mean, it almost is, it's not irrelevant, but to a big degree, I mean, you're trusting that operator, and it's all about that relationship and that you've built and understanding who that is. How do you kind of go about answering that question, right? Investor says, well, Dennis, I don't like that. I don't know the projects that are in the deal, before you're investing in them, or things like that. How do you combat kind of that fear with that passive investor?
Yeah, so I meet all types of investors. I meet investors who, they want to just write the check and they want nothing to do with anything else after that. They just want to make sure they're getting their paycheck every month. But then I also meet investors that really want to learn. And, those are the ones that you do want to take that extra step for. Sometimes, unfortunately, the investor says they really want to learn, but then you'll kind of give them a link and you'll give them an educational resource, and, you follow up and they never did anything. And then you just kind of quickly realize, okay, I'm going to focus my attention on the investors who really, really want to learn. But in terms of my own fund, the way I did it is every operator that I invest with, before I make the checkout, I actually talk to them. I say, hey, I'm a fund of funds. I want to make sure that I have permission to disclose all this information. So what I do is when I get my newsletters, I put them in a shared folder and my investors have that. But I only do that with the permission of my, with the operators I work with, because I consider them as my partners. If they perform really well, I'm going to perform well, and my investors are going to get exactly what they're expecting. So I have a shared folder. They get access to it. Sometimes, the operator will say, I'm not really feeling comfortable with sharing this, but you could share this, or, I might have to edit here and there. But in general, you get a really good view of the portfolio. So, and all portfolios are different. Some portfolios that I've invested in have 2 assets, and basically that's just, a syndication squared. But then some syndications are, some funds are 30 deals, and that's where, unless you have a degree in auditing and stuff like that, it is going to be hard to tell what is what, and you're just investing in the operator at that point.
Yeah, no doubt about it. I just think you're always investing in the operator, for the most part. But thinking about a fund, I know there's many investors who, even learning about syndication was kind of an eye-opening thing, right? They've never heard about syndication before. What does that even mean? Well, it's so out of their wheelhouse, and they weren't told about this growing up. I was not, that's for sure. But then you start talking about a fund, and then it's kind of get that shell shock again, right? And so like, well, wait a minute. Now there's this thing where we can own part of lots of properties. Well, when thinking about that, how do you, when you're vetting operators, or maybe you're answering questions of investors, how are you preparing for a downturn when operating a fund?
So this is where I think diversification really plays a role. By having mobile home parks in the same fund, some Class A assets that that have infinity pools in it, and beautiful gazebos and dog parks and everything like that, you get fairly well insulated, because hey, the same market downturn might not affect the nurses and doctors that are staying at the Class A asset, that it might affect your mobile home park community. And there's all different types of mobile home park communities. So the way that I prepare is, besides keeping ample amount of reserves, is the best thing to do is just to diversify within your asset classes. Like, for example, apartment buildings, there's class A, there's class B, and then everything else, I guess, the joke is that everything else is class C, right? You never hear about class D, but the point is, when you hear class C, you have to really double check class C. But the point is, you want a fund to not only serve just class C operators, you want a great class C operator, you want a great class B operator, you want a class A, you want a great class A operator. And then you go to the mobile home park communities and you do the same thing. And then you do the self-storage and you do the same thing. And what you end up happening is, if the whole economy, collapses, you're going to have pockets in your portfolio that are going to do better. And then, if certain pockets collapse, then you'll still be okay. So reserves and this diversification, I think, is the only way you can really prepare for a downturn.
I like that. Diversification is definitely something that means different things to different people, but definitely something you should be thinking about as a passive or active investor. And what does that look like across your personal portfolio? But also, what are you offering to your investors, right? To helping them to be diversified as well. Dennis, what about, what's your expectation or your thoughts or any predictions just for the real estate market over the next, say, 6 to 12 months?
So this is something that I feel like ever since I got into real estate, it's always been like, interest rates have been historically low and everything like that. And it's just so hard to gauge because I feel like there's so many headwinds and tailwinds going on at the same time. And you could listen to 10 really, really smart people that will completely predict a crash. And then you could listen to like 10 really, really smart people who will predict that the bull market will last for the next 10 years. So I am going to agree with the smart people in my network. And it will either be a crash or it'll be good or it'll stay the same. But I'm not smart enough to know which is which. But I know that I am a fan of investing today, and I'm a fan of investing tomorrow, and I'm a fan of investing because I would rather invest and potentially lose than to sit on the sidelines and just be a commentator. Because if I invest and I lose, I'll still learn something from the deal. But if I'm in the sidelines,
you're still gaining something, right?
You're still gaining something. And, I don't want to go to the bar. I don't want to go to a friend's barbecue and the only investing, advice I'm hearing is how crypto or Tesla, those are not the conversations I want to have. I want to be involved in my own, financial future. And the only way to do that is invest today, tomorrow, and the day after.
What's your best source for meeting new investors right now?
Right now, it's currently just with the book that I published. So I just published the Alternative Investment Almanac. You can find it on Amazon. I'm getting great responses. It's a really easy way to actually learn about different types of alternative investments that are kind of related to each other. So you'll find chapters on mobile home parks and self-storage and life insurance policies. But what I did is I didn't do 300 pages on one topic. So what you end up doing is you end up reading 20 pages on a specific topic, and then it goes into 2 Q&As with 2 expert investors in that topic. So it's a great way to, hey, I really like syndications. I really like how the apartment building model is. Hey, I'm going to go check out Whitney's podcast because I'm kind of keyed in and I know I don't want to do ATM funds. I want to do apartment building syndications. So I wanted this book to introduce a lot of people who are only doing traditional investments, that there is a whole world out there of alternative investments that are not just all Ponzi schemes, and they are, they can serve a valuable role in your portfolio.
Yeah, I've heard a book is like the new business card. I've heard people say that. And how difficult is it to publish a book?
So I self-published, but I have to say I'm in masterminds, and a couple of people around me did it, and I was like, oh, let me do this. It's not that bad. I wrote it in 2 months, and then the work started. Then my editor took over, and that's I can't believe the final product compared to what I did. I feel like I wrote gibberish on a piece of paper, and my editor made it a book. So I'm very thankful. It took twice as long to edit it and format it than to actually write it.
That's why we have a team of experts, right?
Yeah.
No, good for you. Congratulations, by the way, just on making that happen. I know it's no small feat. Dennis, what are a couple of daily habits that you are disciplined about that have helped you achieve success?
So I've been trying to do the miracle morning more and more. I also invested money in a really good chin-up bar that's like steel, not one of those that go on your door frame and then you're scared that your door frame is going to break at any second. I've been doing that. That's been great. And the other thing I just want to say is just being present. It is so hard as someone who's been an investor for 20 years to not look at the future. It's always been like, hey, next year will be different. In 3 years, I'm going to harvest. I think as an investor, the hardest part for me personally has been to learn to say, okay, I think I have enough at this point. What I need to do now is I need to focus on today. I need to focus on my kids. I have 3 kids. I need to focus on my wife. I know you're extremely charitable and you do that. That's all stuff that I think I need to build. And for the last couple of months and probably a year or so, it's all about being present. And it sounds so cliche, but if you're not like constantly reminding yourself to be in this moment, you're just going to think about tomorrow.
Yeah, I appreciate you bringing that up, and yeah, the being disciplined or having the habit of being present. Yeah, it's so difficult, especially as entrepreneurs, and my mind is just constantly going right, thinking about the next thing we're working on or whatever. And man, when my wife and I have been working on like leave the phone in the office. When we're having a meal together or whatever, that notification can wait, right? Until you're able to work again. But you also mentioned an investment in a chin-up bar. I thought that's interesting. You invested in a chin-up bar, and there's a return on investment, right? There's a return as long as you use it. So yeah, getting some exercise in, good for you as well, and just the focus on the family. What about the number one thing that's contributed to your success?
I would say networking by far. When I got into syndications and there was a few deals that I looked at as a general partner, and it doesn't take much to develop your network. I actually wrote a whole chapter about this. So what I always recommend is you use kind of LinkedIn to learn the language of real estate. You want to be careful about not spending too much time with like the 15-minute calls, the offers that you get. But once you learn the language, then what you need to do is, when you go to a conference or a meetup and you get the business cards, follow up with them like right away, and never ever leave an email saying we should stay in touch. Just say like, hey, how about in 2 months, can we put something on the calendar today? Usually people are completely okay with that. And, if they can't make it a couple of times, then yeah, take them off your network. But I've been doing that for 2-3 years, and my network has given me so many opportunities. I got invited to masterminds and different partnerships, and a lot of these investments that I've made from my fund were direct recommendations and referrals from people in my network. And it cuts the due diligence. Not that you should never ever take someone else's word, but being able to get a referral from someone that you've been speaking to for 2 years and you know how diligent they are, it means a lot. And it's a great starting point. And vice versa. If you hear, hey, this operator is, very markety and pitchy and his deals have been performing bad, that means the world, right? You don't have to waste your time looking at that operator. You got to, honest feedback, and, you move on to the operators that are crushing it in their network. So it's a small world out there. I think there's a small world of operators, small world of investors, and it's important to network so that you could get like unbiased information.
No doubt. Networking, relationships. Networking is how you're going to meet those people, right? And like you said, follow up. Even like how you said, not saying, hey, let's stay in touch, right? Like actually putting some action on that and making it so, hey, I'm serious about this, right? We're going to follow back up. I think it's a great mindset to have. I love that. How do you like to give back?
Right now, currently, one of my main priorities is when I do invest in the community. What I want to do is I want to establish a scholarship for that community. So one of the projects we worked on was a mobile home park, and we wanted to open up a small scholarship just for the mobile home park residents. So that's something as my fund expands and we get into more projects, especially in the Class C and the mobile home park segments. I would love to have a continuous ongoing scholarship opportunity where you have some kind of partnership with these operators, and there's really no reason, no negative on their end, to co-sponsor this or something. And it doesn't take a huge financial commitment to get something like this going. So hopefully, as my fund, this is our first year. Hopefully, we could get the scholarship going either by the end of this year or next year, and that's something I'm super passionate about.
Awesome. Well, Denis, it's been a pleasure to get to meet you and have you on the show and really just dive into a fund structure that's different, I think, than probably any fund specifically that we've talked about on the show. Thinking through that, building an income fund, right? So provides different benefits to investors that are looking for that income now. So definitely something to keep in mind. I just appreciate your willingness to be open about how you've structured the fund and why, and mortgage notes and ATMs and being more diversified. Tell the listeners, though, how they can get in touch with you and learn more about you. Yeah,
the best place is www.sihcapitalgroup.com. If you go there, I have a free ebook it's a smaller version of the book that I actually published on Amazon. So feel free to sign up on your email list, or there's a contact section. So feel free to just send me a pop-up. I also have close to 30 to 40 articles of educational content that goes over funds and preferred returns and all the basics and some more advanced stuff. So the best place to learn more is www.sihcapitalgroup.com.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.